You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 26th of April 2026, and I'm joined today by my co-host John McEwen. In this week's episode, we'll be discussing Imperial Brands, Unite, Barratt Redrow, ASML, Tesco, and our non-UK, our non-European company of the week is Taiwan Semiconductor Manufacturing Company. John, do you want to start us off with Imperial Brands?
Yep, so it's a trading update from a few weeks ago now, with Imperial Brands announcing that they're going to have low single-digit growth in the first half underlying revenue when ignoring currency movements, and a small decline in combustible volumes has been more than offset by strong tobacco pricing and improved next-generation product sales. In aggregate, Imperial expects that the share of its top 5 markets has declined modestly during the first half, reflecting a greater focus on more profitable segments. Underlying operating profit was slightly higher than the same period last year. The company noted a more uncertain geopolitical and macro environment. However, financial performance is still expected to improve in the second half, and full-year guidance for underlying operating profit growth of between 3% and 5% and free cash flow of at least £2.2 billion was unchanged. Just under half of this year's £1.45 billion share buyback has now been completed, and the shares were down nearly 8.5% in early trading. In terms of valuation, Imperial Brands has a market cap of £21.5 billion and trades at 8.6 times forward earnings with a prospective dividend yield of 5.6%. I didn't think there were any huge surprises here. Obviously, it was slightly disappointing for the group of what they described as some overall modest aggregate share reduction across the top 5 markets in the first half. And top 5 markets for reference are the US, Germany, the UK, Spain, and Australia. They didn't actually put a figure on that, but I think it is worth noting that over the past 5 years, market share has increased by 48 basis points. The valuation is not particularly stretched. The dividend yield is lower than it has been over the last 10 years, particularly as the shares have re-rated more over the past couple of years. Next generation products, they're doing reasonably, not yet profitable as they are with the more mature division in British American. And I think the group have a very clear commitment to returning cash to shareholders. It has been some pretty huge dividends over the last 5 years and some pretty chunky share buybacks too, particularly when the valuation was lower. Overall, obviously ethical sort of concerns aside, it's a reasonable dividend. I think, though, having followed it for a few years now, for 5 years now, it looks fairly valued. The dividend is, as I say, reasonable. I don't think it looks quite that value prospect that perhaps it did maybe 3 to 5 years ago. And I think if people were looking for more of a geographical spread, their competitor, British American, has more of that, albeit probably has more debt too. I'm neither here nor there with it, is probably where I'd sit now. Sam, what do you think of Imperial Brands in this trading update?
I don't think there's any huge surprises. I'm surprised, contradiction there, but I'm surprised the share price was down that much. But in terms of the results themselves, I thought they seemed pretty good. The market share decline is a shame, but overall, I think it's the sort of results we've gotten used to. I'm surprised the shares were down as much as 8% on these results, but they have been quite pricey and have re-rated a lot. I think in terms of the valuation, it's all right. I think that yield of 5.6 is okay when you factor in that you're getting buybacks on top. But I think, like you say, compared to where it's been historically, despite the fact it's pulled back a bit, it's still looking quite expensive. And I just think it seems to move a lot with kind of sentiment. And when you get a bit more market uncertainty and people move into more defensive positions, it tends to do quite well. So I just think, having followed it for so long, you've had lots of opportunities to buy at a very, very reasonable price. So if you are looking at it and it's in the watch list, I'd just wait, because I think at some point you'll get a chance to buy it probably at a better value than a forward PE of 8.6.
Fair enough. Okay, on to Unite. We haven't covered them for a while.
Yes, I think it must have been a few years. So Unite Group, for anyone who's not familiar, they are a REIT, and they are the largest provider of student accommodation in the UK. So they have come out with a Q1 trading update, and they've said that for 26-27 letting performance across the student portfolio, 74% of beds are now reserved for the 26-27 academic year, and that's down slightly from 76% a year ago. This includes 54% of beds let to universities under nomination agreements and 20% of beds let through direct let sales. In 25-26, 58% of beds were let to universities under nomination agreements instead of 54, and 18% were direct let sales instead of 20. They've said the sales programme for the next academic year remains in line with the guidance provided at the preliminary results for an outturn at the lower end of 93-96% occupancy and 2-3% rental growth. That compared to 95.2% occupancy last year and 4% rental growth. For the Empiric, which is Hello Student update, they've said that bookings for the Hello Student portfolio continue to progress in line with the expectations. 33% of rooms are now reserved for 26-27, and that's down from 48% a year ago, reflecting a delayed start to the sales cycle following a technology upgrade in late 2025 and expiry of single-year nomination agreements. We've made a number of interventions to Empiric sales plan, including onboarding their properties with our international sales team and agent network. We continue to expect Hello Student to achieve occupancy of around 85% for 26-27, in line with Unite's direct let sales. The integration of Empiric continues to progress well, and to date we've delivered 3 million of annualised cost synergies. We remain confident in delivering our target of 9 million annualised cost synergies in 2026 and 17 million per annum from 2027 onwards. At 31 March, 100% of the group's debt was subject to fixed or capped interest rates, providing protection against future changes in interest rates. They've talked about the Renters' Rights Act, the new rules, which have been pretty widely publicised, so we won't go into them, but they have said that for HMO landlords, which is houses of multiple occupation, which a lot of student-lets tend to be, the most significant changes are a ban on tenants entering tenancy agreements more than 6 months before the start date, and the ability for students to exit HMO tenancies with 2 months' notice. We expect the new regulations to be beneficial to PBSA over time, contributing to the trend of declining supply of HMOs. So that's quite an interesting take, that the legislation is so bad that there's going to be a decline of houses of multiple occupation, so they're going to benefit from basically decreased supply. I do think it's interesting as well in terms of those rules where you can't enter a tenancy agreement more than 6 months before the start date. When I was at university, you would get your accommodation sorted for next year, typically in that first term, ideally, which you would no longer be able to do. You would have to wait till kind of really Easter before you could actually do it. And the fact that you can leave with 2 months' notice, you would often get situations where housemates might fall out or something like that. And they would be locked in for the entire year. I don't think it was uncommon when we were at university. Again, I think that 2 months' notice could be a bit of a problem, because once someone leaves partway through the academic year, you're very, very unlikely to fill it until the next year, I think. So in terms of the valuation, well, the business trades at a yield of 8.06 because it's a REIT, so they do pay most of that out. And in terms of the PE, it's actually a trailing PE at the minute of 23.5, but the forward PE is 11.25. I suspect that's because of the costs of the acquisition of Empiric, which we did touch on in the statement. So in terms of the share price as well, they're actually down 60% in the last 5 years, and in the last 12 months they're down 46%. I did have a quick look at why, partly because of the growth. Also, the asset values have been declining. So again, even in this trading statement, the portfolios have both had small reductions in the capital values, so 1.7 and 2.4% for the two portfolios. The rental growth slowing. They've cut guidance a few times prior to this statement, and I don't think the acquisition of Empiric has been viewed that well by the market. I think as well, I suspect the new rental reform agreement has probably had an impact, because I think for a student lender, those problems that I outlined, it's not great. That being said, it's probably a decent quality portfolio, and I think at a yield of 8%, you could probably do worse, especially if you were to take a view that maybe if you could ride out the current administration, it might be quite likely the next government might repeal a lot of these rules if they do turn out to be quite damaging to the market. Whether that happens or not, I don't know. But I think at a yield of 8%, I don't think it's looking terrible. Well, I suppose if you were to look at it more, actually, we'd probably need to know what level most of the debt's fixed at. It's not in this trading statement, so we would have to dive deeper, which I'm not particularly interested in investing in, so I'm not going to do. John, what do you think?
Yeah, I mean, there are a few points that I'd mention. I think the rising interest rates, I know a lot of it is fixed at lower rates for the group, but going forward, and certainly when they need to borrow or refinance those deals, it's certainly likely to be more expensive. I think other worries I would have would be the reduction or potential reduction of those going to university, if more people are doing apprenticeships and there's less of that drive that's, I guess, started under Tony Blair for over 50% of people, or, the majority of people, to go to university. And then I suppose you'd also have to look at who is going to university. Is it sort of just the domestic, UK students, or is it internationals? I think if it were, larger numbers of internationals coming, then that would be, a real positive for Unite. But if it is, more domestic UK students, and increasingly you wonder whether it is, more of the domestic market, they probably don't have as much money to spend on that kind of premium product or more premium product that Unite's offering. Anything else? I think probably if you were just looking at the Unite within the context of other REITs, there are a lot of great REITs at the moment on the UK market. And I think there are other safer bets and with better, growth potential ahead of them than Unite. So for me, I wouldn't go further on that basis.
Should we move on then, but remain in a similar industry?
Yeah, no, similar industry. So Barratt Redrow, it's one that I own. They had their third quarter trading update out, with Barratt Redrow's net private reservation rates rising by 6% to 0.67 in the 13 weeks to the 29th of March. The order book grew by 13% to £3.5 billion, reflecting a total of 11,395 new homes. Build cost inflation is expected to be around 2% this year, and helped by lower land investment, year-end net cash is now expected to land between 550 and 650 million pounds. Previously, it was guided at 400 to 500 million. Full-year completions guidance has been reiterated at between 17,200 and 17,800 new homes, and underlying pre-tax profits are expected to land in line with market forecasts, pointing to growth of around 16% to £568 million. And Barratt has completed around £84 million of the current £100 million share buyback programme, with the remainder to be finished by the end of June this year. And the shares were up nearly 2.5% in early trading. In terms of valuation, the group have a market cap of £3.6 billion and trade at 0.45 forward price to book, compared to the 10-year average of 1.05, and the shares currently yield 6.4%. I actually thought these were the best results we've seen, or the best update we've seen from Barratt in some time. I suppose the difficulty is that the share price isn't reflecting that, and I don't really see the shares re-rating anytime soon, given the macro situation. Appreciate it doesn't seem too bad in this statement, but I don't think there are any clear signs that the house building bonanza that I wouldn't say we expected, but we might have hoped for, with the sort of promise for more regulatory relaxation under the current government, hasn't really materialised. I think build cost inflation, I know they're saying it's 2%. When we looked in terms of the brick makers, and specifically Ibstock, you feel that a lot more build cost inflation with those higher energy prices is going to be coming down the track. And I would be amazed if it does stick at 2%. Other things, I think interest rates, the concern there that they're at least going to be held, that they may go up, and particularly if inflation does kick on. So yes, I think the shares are in some ways cheap, but I think you'd have to take a long-term view, which is what I do to make the case and be very patient. But I think it could certainly be a bumpy year or two for Barratt Redrow. Perhaps if there were a different government, if there were, or a new prime minister, even a new approach to cutting red tape, maybe, or even some more stimulus, then perhaps we could see things changing sooner. But I'm a bit more pessimistic in the shorter term for the house builders. Sam, what are your thoughts?
I thought this was quite a good update, especially that 2% cost inflation. I know you expressed some skepticism, but I think if they could hit that, that would be fantastic because, we have gotten used to seeing it quite a bit higher. And the issue is they've, I think, struggled to raise the price. I think we are just getting to a point where it's just becoming much, much harder to buy a home, especially if you're sort of paying that premium for a new property. So in the last few years, I think the costs have gone up, but the prices haven't really gone up as much. So unless they can build more properties, it's difficult for them to deal with that. So if they can get that cost inflation back down, I think that would be very positive for them. But yeah, whether they do it in reality, I'm not sure. Or as to how long it actually stays down for, I'm not sure. But yeah, I think on the surface of it, I think it was a very good statement. And I think, certainly as positive as anything that we've seen from kind of Taylor Wimpey or Persimmon in recent weeks.
Would you be interested in a house builder at the moment?
Probably not, but I think if you don't mind a couple of years of uncertainty, I think you can do a lot worse, and I think the yields are pretty good on them. But I think in terms of anything that's really going to sort of unlock that value, you're probably waiting for a change in government. I think a lot of the issues with house builders now is sort of, who was it who stopped buying land now?
So even Barratt Redrow. So Barratt Redrow have cut land buying by £200 million.
Oh, so Berkeley Group. So this isn't the one I was thinking about, but Berkeley Group, they announced that they're going to stop buying new land and implement a hiring freeze. They announced that this month. Barratt Redrow, like you say, said they'd spend less. It looks like Taylor Wimpey have reduced the spend, but they've not cut it down entirely. But anyway, so I just think as an industry, it's difficult because I think we are kind of at a point where house prices have gone up more than wages. So especially for the ones where they're sort of targeting first-time buyers, there's only so much more they can raise the price. So then you either get some kind of government initiative, which I don't really like anyway, because it's, I've talked about before, it's a demand-side solution to a supply-side problem. What you really need is you need them building more houses, and I don't see that in the next few years, but we'll see.
Yeah, and it's worth saying that the shares are, I think, as low as they've been for, over 10 years, about 13 years. So how's the growth industry in the form of AI and ASML going, Sam?
Pretty well. So ASML, I won't go into excessive detail because we have covered them before in terms of what they do, but they're the market leader in lithography machines, which are used to make semiconductor chips. And as we've talked about before, they have an absolutely huge moat because to actually get into that industry, it's very, very specialized. And they're basically sort of the only company in the world that can do it at scale because of the amount they've kind of invested in it. So to actually go and try and knock them off their perch would be unbelievably difficult. So ASML, they are actually a Dutch company and they have come out with their Q1 results. So they reported I think they might actually be the biggest company in Europe. It's definitely not Novo Nordisk anymore. Yes, a market cap of 475 billion euros. So I think that must be the biggest in Europe. Yeah, it is the biggest. So they've come out with their Q1 results and they've reported a 13% rise in first quarter revenue to 8.8 billion, and that's higher than the 8.5 billion that was expected, with a gross margin of 53%. Operating profit rose to 3.2 billion, and that was higher than the 3 billion expected, and that was an increase of 15%. There was a free cash outflow of 2.6 billion, but the net cash on the balance sheet is 5.7 billion. They announced a final dividend of €2.70. However, that's on a share price of 1,249 euros, so it's pretty small. And they've also announced 1.1 billion of share buybacks that were completed in the quarter. Again, that's on a market cap of 475 billion, so not a huge amount. For the coming quarter, revenue is expected between 8.4 and 9 billion, with gross margins of 51 to 52%. For the full 2026 year, revenue is expected to be between 36 and 40 billion, and that's been raised from 34 to 39 billion, with gross margins of 51 to 53%. It's worth noting at the minute their technology is largely barred from sale into China due to US and Dutch restrictions, and China is expected to drop to around 20% of sales, with other geographies making up the shortfall. 2026, expecting to see profit growth of about 20% for the year. It's actually quite a poor year for them. They're expecting that to re-accelerate about 30% in 2027. So now we get onto the valuation. So in the past 12 months, it's up 113%. I don't think it was particularly cheap 12 months ago. So in terms of the valuation now, they trade at a forward P of 39.8. That compares to a 10-year average of 31. Prospective yield is 0.7%, and that compares to a 10-year average of 1%. I think it's a fantastic business. It's a business I would love to own. Unfortunately, I think it will be a long time before I get the chance, because I mean, on a trailing basis, the P is actually 47.5, but yeah, forward 39.8. Really expensive. I think sort of that AI boom probably will go on for the next few years. If they're growing profits 20 to 30% a year, that soon comes down, but I'd just be a bit uncomfortable, because if you're buying now, you probably need 3 or 4 more years like this before it's actually a fairly reasonable valuation compared to what you paid, and I just wouldn't really be comfortable with that. John, what do you think?
Yeah, fantastic business, but I wouldn't invest on a valuation basis. And yeah, that's, and I appreciate the business can't help that, but as a retail investor, that would put me off.
Yeah, in terms of the results, though, nothing to criticise.
Yeah, absolutely.
Should
Okay.
we move on to another business that's quite expensive now?
Well, I was about to say that. I was going to say more fairly priced, but it is actually, I think, pretty fully valued, but we'll come on to that. So it's Tesco's, which is Britain's largest retailer. They had their full year results out a couple of weeks ago, with full year retail sales rising 4.3% to £66.6 billion, ignoring exchange rates. And the uplift was driven by growth across all business divisions and regions, as market share reached its highest level in a decade. Underlying operating profit grew at a slower pace of 0.6% to £3.2 billion, which was broadly in line with expectations due to cost inflation. Free cash flow was up 11.8% to £2 billion against the £1.7 billion expected, and net debt rose by 12% to £10.6 billion as the proceeds from last year's £700 million sale of its banking operations have since been returned to shareholders. The year ahead, full-year underlying operating profits are expected to be between £3 and £3.3 billion, and free cash flow is expected to land between £1.5 and £2 billion. Full-year dividends increased to 14.5 pence a share, up 5.8%, and the shares were up around 3% in early trading. In terms of valuation, the group have a market cap of £31 billion and trade at 14.9 times forward earnings, with a prospective dividend yield of 3.4%. I thought these results were really good, particularly when they delivered so consistently over the last, at least 5 years now. They're by far the dominant supermarket. They're the most efficient. They have the best supply chains. They also have the wholesale booker. They've really trimmed the fat over the past decade and got rid of all of that bloat that had built up previously when they'd been buying cafes, gyms, and all sorts. Got out of America and just really focused and honed in on the UK market. And they really do have that dialed down. They take market share from higher up with the finest range, from your sort of M&Ss and the like, but then also lower down. The German discounters aren't the threat that they were a decade ago, and they've got their sort of Aldi price match. They're able to compete because they are so lean on price, and the management over the last 10 years have done a fantastic job. Sadly, the share price now reflects that. They've re-rated a lot, and I think 14.9 times forward earnings for Tesco, given where they are in the market, is now, I don't know whether I'd say expensive, but I think fully valued. It's a business that I used to own shares in. I sold it when the turnaround was underway, but I sort of wish I'd held on to it for a bit longer to see it fully reflected in the valuation and the share price. But yeah, I think great business. I wouldn't be buying shares now. I think it is fully valued. Sam, what are your thoughts?
I think the retail sales growth of 4.3% is good. I think the operating profit growth of 0.6% is disappointing. But like you say, they've got the Aldi price match. When things get a bit tougher, I think they do have a strategy now where they'll try and hold on. They won't raise prices like they did kind of previously, where they then lost it to kind of the German discounters. So that does then eat into the margin sometimes. But I suppose on the flip side, market share's highest it's been in 10 years, which is all they can really do. So operationally, I think they're doing all the right things. It's a bit of a shame that the operating profit growth so low, but I think that's been done in the best long-term interest of the business. So I don't know if we've just been a bit spoiled and gotten used to seeing it at kind of like 11 times earnings, but 15 just makes me feel, well, actually, yeah, the 10-year average is 12 and a half. So like 15 just makes me feel a bit uncomfortable. So although it's a high quality business, I just kind of think, like you say, they've trimmed a lot of the fat, but it's not entirely obvious where the growth is going to come from now. I think the only argument that I can really think of is that with Asda and Morrison's being like either PE owned or Asda's owned by the Isa brothers, but they took on a lot of debt to buy it, so it may as well be PE. In terms of the way those businesses are heading, there might be more opportunities to take market share. But other than that, there's not a huge amount that suggests that paying 15 times earnings for this is actually, where's the capital growth going to come from? I struggle with that, but that's not the business's fault. And I think operationally they're doing all the right things.
Fine. On to a debut on the show.
Yes, so Taiwan Semiconductor Manufacturing. So it's probably not a company that needs much introduction because it is one of the most well-known and biggest companies in the world. So for context, they have a market cap of 1.69 trillion with a T. They make semiconductors, as you may have guessed from the name. So they are the world's biggest semiconductor manufacturer, and they don't design their own semiconductors. They just manufacture for clients. So the clients include Nvidia, ARM, Apple, basically kind of probably any big tech company you can think of, really. So Taiwan Semiconductor Manufacturing Company have come out with their first quarter revenue, and it rose by 35%, ignoring currency movements, to $35.9 billion, and all these figures are in dollars. And that compares to $35.2 billion expected. Growth was supported by strong demand for leading-edge technologies, particularly in high-performance computing, otherwise known as AI. Operating profit increased 62% to $20.9 billion. That's not bad at all, is it? Operating $20.9 billion operating profit on revenue of $35.9 billion. That's very good. Helped by operating expenses growing at a slower pace than revenue and improved gross margins. Free cash flow was $11.1 billion and net cash stood at $73.8 billion at the end of the period. Second quarter revenue is expected to land between $39 and $40 billion, and the shares were at 1% in pre-market trading. I expect the margins, I'm just going to check those margins actually. I'm going to see how they compare to historic, because that just seems really high for something that makes something. Almost makes me wonder if it's a typo. So income statement. Oh, wow. Yes, it's got about 50% operating margin every year. That's ridiculous for a company that builds stuff. But anyway, so the margins will be coming down slightly, however, because they are expanding into the US and Japan to diversify supply, and the costs will just be higher as a consequence. However, they've not had really any issues from tariffs, and that's because they have made pledges to build sites in the US, which is why those margins will be coming down. However, the US accounts for about 75% of revenue, so I think it's probably the right move. In terms of valuation, the business trades at a forward P of 24.8, 10-year average is 19.4, prospective yield is 1.1%, and the 10-year average is 2.5%. I think these numbers are really good. I think the valuation is pretty reasonable for the growth. I think the margins are really, really high. I am assuming that, compare it to sort of, ASML, and I'd say it's a similar quality business, probably putting up kind of similar kind of numbers. 4P of 25 compared to 40. My guess would be that it's more of a geopolitical thing with it being so close to China, and whether that gets swallowed up at some point. That's the only thing I can think of, because on the surface, it actually seems pretty reasonably priced for the industry and growth rate. What do you think, John?
Yeah, I think it's geopolitical risk that's factored into it, but an amazing company and one that will be in my index fund. But would I be brave enough to buy it outside that? I'm not sure.
Yeah, I think I'd be the same, because I think it's not. I think you could make an argument for it, but I think it's a very real geopolitical risk.
Yeah.
So I can understand it. So, but it's not an obviously ridiculous valuation. So you could argue it's maybe fairly reflected in the price. But
Yeah. No.
of these 6 companies then this week, Imperial Brands, Unite, Barratt Redrow, ASML, Tesco, and Taiwan Semiconductor, which do you like the most and which do you like the least?
So, I mean, as a business, I think ASML hands down, but current valuation, I'd probably go with Barratt Redrow and take the long-term view with that. In terms of last, I'd probably go Unite. I think it's a difficult sector. There are a few headwinds at the moment, and I don't see huge growth ahead of it. So that would be my last.
So I think for me, I think Unite's an easy last. I think first, I'd probably actually do Taiwan Semiconductor, but it's with the caveat I'd almost certainly never buy it. I've looked at Chinese businesses in the past, and I've owned Baidu for a while, and I think I know it's not Chinese, but it could be one day, and I just think it just makes me a bit uncomfortable in terms of the corporate governance and stuff. If that were to happen, yeah, I'd just rather just avoid something like that. So, but in terms of kind of valuation and overall of those 6, I probably do like it the most.
Okay. Well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW Tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.